Good evening, everybody. How's everybody doing today? Welcome to Financial Independence Through Small Multifamily Investing. My name is Lawrence, Mr. International Laddie. I am also part of the Jerome Myers Methods, and I'm also a member of the GOB Network. I have 6 units here in New York City, but I'm also looking at other areas of the United States, mostly the Southeast, the Piedmont Triad area, Norfolk, Virginia, and Huntsville, Alabama. So now, with no further ado, we're going to talk about insurance tonight. This is going to be a learning course about insurance, the do's and don'ts, right? The mistakes you shouldn't be making, right? From a gentleman, Jeremy Goodrich, all right? He doesn't call himself a insurance broker. He calls himself an insurance advisor. I like that, Jeremy. I really do. That's great. And he's also the host of a top-rated podcast, REI Clarity. All right. So, Jeremy, go ahead.
Awesome.
Welcome.
Well, thank you, Lawrence. And do you mind if I share my screen as we get into this?
Sure. Hold on. Let me just hook you
cool.
up there. There you go. Let me
Good.
hook you.
So my name is Jeremy Goodrich, and I'm a former elementary school teacher. I spent about 13 years teaching in schools. And at some point at the end of that time, I met my wife and now business partner, Mackenzie, and she was a third generation insurance agent. And so we got married during that time, and her dad, whose agency she worked at, sold his agency, and she knew she just didn't have anything going there. And so we started Shine. And our goal was to change the way people feel about insurance, to make smart insurance simple. And so we've continued to do that over the course of the last 8 years. And because I had no real knowledge of how to be a salesperson or an insurance person or anything like that, I really have always stuck to my education roots. And so when I first started Shine, I started working with first-time home buyers. And they asked me about insurance, but for whatever reason, they asked me about other parts of closing deals. You know, how do you find a good realtor? How do you find a good lender? What the heck's a title company? What's an appraisal, an inspection? You know, all these pieces of the puzzle they were asking me about. And I didn't really know the answer. So I started going out and asking people who did know, realtors and lenders. And I videotaped it and put it on YouTube. So I would sit down with people with microphones and do that. And that channel has now grown to about a 15,000 subscriber YouTube channel. And the idea of helping people with real estate at all different levels has continued to happen. So it was first-time home buyers then, and then I grew into residential, single family to 4-family homes, schedules of those kinds of things. And then for the last 2 or 3 years, I've been 100% commercial real estate. So what I do as an insurance advisor now is work purely with commercial real estate investors. That's multifamily, office, retail, industrial, some self-storage, and working in those spaces. And I've had the privilege of being in the middle of a whole lot of deals. Now, I'm not the GP, I'm not an LP, although I am early in my LP journey. But I'm a service provider. And I think that the perspective that we provide is really important. And I get to see a lot of deals without the tension of being in it, right? And so that's the background of me a little bit. And what I want to talk about tonight, and one, if you have questions while we're running through this, please throw them in the chat. And Lawrence is going to let me know because I might not be able to see them. But just let me know. So what I want to do here, and it sounds like everyone in this room is in the perfect place to hear this presentation. I can promise you by the end of this presentation, you will see this particular service provider, your insurance advisor, differently than you do right now. I'm going to tell you 4 stories. They're real stories. I've changed the names and made up pictures in here. But I'm going to tell you 4 stories of real people who lost something because they did this wrong. And then I'm going to show you exactly what you can do to fix that. So I'm going to share my screen here real quickly. And Lawrence, let me know. Can you see my screen?
Yes, indeed.
Okay, cool. So I'm just going to pop through. And what we're going to do is we're going to talk here about the victims. So the 4 victims of these scenarios, the crimes, what those scenarios were, and then of course the solutions as we come to the solutions of those scenarios. So let's introduce you to the 4 people. Again, I made up the pictures. I'm not going to put people's real pictures or real names on here, but I want to tell you who these folks are. So the first ones are the ones we'll dig into the most. This is Rico and John. They own 144 unit multifamily. Value add for this particular one. When they bought it, it was a heavy lift, about 40% occupied. They were doing a lot of due diligence, or excuse me, a lot of value add on the property. It was an acquisition right outside of New Orleans, Louisiana. So that's the first one. These folks lost $140,000 in the scenario that I'll describe to you here. Janine is in Montgomery, Alabama, 100 unit distressed property as well. She was looking at distressed property, and this was an acquisition. What she lost was a $2 million deal in the mistake that she made. Donnie has a residential schedule. It sounds like some of you on the call today may connect with that. Was using the Burr method, had about 30 to 40 properties at the time of the story I'm going to tell you. He's in Indianapolis, Indiana, lost about $200,000. And then finally, Josie and Maria, they're my final example, 36 units, value add. It was a JV between the two of them in Cincinnati, Ohio. And what they lost in some ways might be the most interesting of all of them. And that is simply their peace of mind. So what are the crimes? Well, I just gave them sort of cheesy names so we could remember them. So the first one is the crime of cheap. The second one is Sellers the feller. The third one is get her done. And the fourth one is I don't speak insurance. Again, the first one I'm going to dig into really deep. I'm going to pull back the curtains of how insurance really works in these scenarios so you can truly understand. I already shared a bit about me. I'm the owner of Shine Insurance. Commercial real estate is all I do. It's all our commercial team does at Shine Insurance. We are 100% focused on commercial real estate, and I have hundreds of investors that I advise. And I'm very early in my LP investing journey, like super early. But that is the way that I'm moving into actual ownership of commercial real estate. Let's talk about Rico and John. This one is cheap. And we all know this story. If you can't beat them on price, I'll take it. Or if you can beat them on price, I'll take it. So they're picking up 144 unit multifamily, like I already said. So what happens here? And maybe all of you have done this, or maybe this is how you think insurance works in the commercial space. You're going to ask 4 agents to send over some quotes. Probably pick the cheapest one because quotes are confusing and they're hard to really know what it is that you have going. Done. Pretty easy, right? Let's see how that plays out. This is about 80% of real estate investors buy insurance this way. I use a fact a lot that's 80% of real estate investors have insurance policies that will fail them when they need them. And I'm going to show you exactly why in this scenario. So I created a little overview here to give you an example. This top part is 4 insurance agents that Rico and John reached out to. And this bottom part is all the insurance companies that they have access to. Now we have access to much more than whatever this is, 6. But this is just the example to show you. So let's just say that the agent you'd like to work with is this second one right here. It's the one you trust, maybe as a friend, maybe as a thought leader in the space. You heard him on a podcast and you feel like, boy, I'd love to work with that agent, the second one. So that's just a way to say it. And also, there are good insurance companies and there are bad ones. I will tell you 100%. There are definitely good insurance companies and there are definitely bad ones. So let's say these 2 over here are the bad ones and these over here are the good ones. And these, whatever, they're in the middle. So let's see what happens. The first person you tell is this person over here. This is the most important part of this presentation is what I'm about to say right here. The first person you tell goes out and does what's called blocking the markets. The first person that gets to an insurance company in the commercial real estate world is the only one who can quote that company. So once they have gone and blocked that market, no one else has access to that company. And so the first lesson I would say is if you are going to ask more than one person to provide proposals for your insurance, make sure the first person you tell is the one you want to win, because that's 90% what's going to happen. So the first person goes out and she blocks all the markets she can. She blocks the good companies. She blocks the mediocre companies. She doesn't need to go to the bad companies because she's the one with access to all the best stuff. That makes sense so far? So the second person is the one you wanted to work with, and I would argue the one who is the responsible one. That one goes out, starts looking at companies, and we can tell if other people have gone to companies because, of course, obviously they are, blocked. And so that person says, this isn't how I play ball. This isn't how I do business. I'm here for relationships. I'm here to be a part of your team. I'm here to be on the journey for you. It looks like you're just looking for me to schlep quotes. I'm out. Oh, wait. So she blocks those. There, I've got a visual for that. He's out. So now the person that we wanted is out simply because we didn't tell him first. Okay. But look what happens. Now, these other two people, she tells, and they see that these are blocked, but they want the money, they want the deal. They want to make the money. Insurance agents make about 10 to 13% of the premium you pay for insurance. So if your multifamily property is going to be a $20,000 policy, then we're talking about a few $1,000s that insurance agent could make. Insurance agents like to work with multifamily investors, whether they know how to do it or not. So those other two people are like, well, I don't have access to these markets. What am I going to do? Well, they're going to do the natural thing you're going to do if you don't have integrity, I guess is the way to say it. They're going to go get quotes from the bad companies, right? So now you've got quotes from bad companies, from two advisors. You've got nothing from the advisor you wanted, and you have one advisor who's really holding all the cards in this situation. So what happened? Well, what motivation have you created? It's simple, right? It's price and price only. All of these people are motivated by price because there's nothing else to be motivated by because you've put them in a bidding situation. So what was the outcome? Well, option one was the first person you told. 113K was the premium for this. You say 144 units. That's pretty high for 144 units, and you are correct. But coastal properties that are heavy lifts in Louisiana are expensive. I know this story actually because I was this option, and they came back and told me what happened.
Okay, so you can come back for a few minutes. You can't go in the room, but you can visit.
So option two with a bad company, 103K, right? 10K less. That's pretty, I mean, and how do you know the difference? It's very hard. And so what did Rico and John pick? Well, they picked the $103,000 policy because it made sense. And that's probably what a lot of you would do as well, because it's just hard to know the difference. About 6 months later, I guess there's so there was some huge coverage issues that made it cheaper, which is the problem. And here are some of the things I see over and over and over again. 80% of real estate investors have policies that will fail them. This is why. The buildings were underinsured. ACV coverage, which is nerdy for depreciated coverage. When you're talking about taxes and cost segregation, depreciation is good. When you're talking about insurance claims, depreciation is bad. ACV coverage subtracts depreciation. Co-insurance clauses, the hated co-insurance clause where you end up getting penalized for underinsuring. There were some hidden exclusions, higher deductibles, and there was no loss of income coverage. So that is what they sacrificed to save $10,000 in a claim scenario. 6 months later, fire happens, $500,000 claim. Okay, using this as an example, but these folks came back and told me this story later, and we talked about it. So let's look at the difference in the insurance payout between the two options that they had. Remember, $10,000 difference in price, $500,000 loss. The one they chose had a $25,000 deductible. So subtract 25K. ACV depreciation was figured at $75,000. Subtract that. The co-insurance penalty for underinsuring, subtract 50,000 more. We end up at a $350,000 insurance payout. Honestly, I'd say that's lucky. I used a pretty tame example here. The other option, $500,000 loss, $10,000 deductible. Even the deductible was even different. It had replacement cost coverage, so there was no subtraction for depreciation. It was properly insured, so there was no subtraction for co-insurance penalty. The payout, $490,000. So when we look at the two different insurance policies that were $10,000 different in their price, there was a $140,000 difference in the payout in a claim. You saved $10,000 and that was fine, but then you lost $140,000 in the scenario where you actually had a claim. So what's the problem? The first agent you tell has the upper hand. That's not necessarily a problem, but I don't know how to get backwards. I can't remember what the second problem was. I skipped past it and I can't get this. Let's see if we can go backwards here. There we go. And motivation is a race to the bottom. I think anytime you create a race to the bottom motivation, it doesn't work. I have some of the best prices in the industry, but I am often more expensive than another person. And the reason is difference in coverage, not difference in rate or price or capacity to find the best price. And so if you create a race to the bottom, that's the problem you create. Outcome, a terrible policy, a terrible agent, no advisor, clearly, because they weren't giving you clear advice, and $140,000 out of pocket in that claim. So finally, what's the lesson? Let your advisor make companies compete. I go out and I make 50 companies compete. So that's the difference there. Focus on quality coverage and price. I'm not saying get the most expensive insurance policy you can. Nobody wants you to do that, nor I don't want you to do that. I want you to focus on a combination of the two. And cheap insurance is expensive. The cheapest person in a bidding war is likely a piece of paper that's not going to do much for you in a claim scenario. So let's stop there for a second and see if we have any questions before I go on to any other examples. That was example number one. Lawrence or anybody else, do y'all have questions?
So, quick question. So you're saying that the first person, right? I'm going to get a clear understanding. The first person that you ask for locks everybody else out when they go to these different companies.
Exactly. I mean, it's a little bit oversimplifying because there's lots of insurance companies and depends on who that person has access to. I've got access to a lot of companies. I'm going to go out to all those companies. So if you tell me first, I'm likely to block most of the options the next person you ask would have. But if the other person has different options than I do, then like I don't push a button and block every insurance company in the world.
Right. Okay.
But they're blocking those that they have access to.
Okay. It's just scary. That's all.
Well, it's fine. You want to make sure the first person you ask is the person that you trust, the first person you feel has access to the best companies. And I can't see the chat, by the way. I've set this up, so if there's anything,
there's nothing in the chat. There's no question in the chat.
Okay, cool. You ready for the next one?
Let's go.
All right. So that was a long one. So we'll slow it down, or these are a little bit quicker. So let me scoot this up so it's full screen. There we go. So remember Janine, this was a 100-unit distressed acquisition, Montgomery, Alabama. I really liked this property a lot, actually. It was, I think, 10 buildings, 11 buildings, pretty distressed, but the investor had really, it was an international investor that owned it, that she was thinking about selling it from, and had really sucked all the money out of it. So they had just driven it into the ground. And that particular neighborhood, or that particular portfolio complex, was in terrible shape, but all the properties around it looked really, really good. And the neighborhood looked good. Montgomery is a state capital, so I think there's a positive there. There were a lot of positives about this market, a lot of positives about this property. I liked this property a lot. Janine came to me very late, and that is, this is called the seller's the feller. I'll just plug in the seller's numbers, is the mistake that Janine made. So what's that look like? Well, the problem is the seller. So maybe I should explain it a little bit more. When you start underwriting a deal, when you start to pencil, you often have a lot of the seller's numbers. You get T12s, rent rolls, whatever they have to show you in that process, or whatever the broker has, and you're going to plug those numbers. That can be off, as most of you know, on all sorts of things, and insurance is no different. What I see a lot is folks plug sellers' numbers and then come to me late in their due diligence process like, oh my gosh, I've got a fire on my hands because I'm getting quotes, hard quotes from people, and they're all twice as much as I underwrote for. So that's the scenario here. And why does that happen? Well, the seller, I guess, could be throwing you baloney numbers. We like to hope that's not the case, but surely that can happen sometimes. Or the seller, in this case, you've got a heavy lift. The seller got their insurance 10 years ago. It was in great shape then. Whole different property, not going to be as expensive. Maybe the seller has 10,000 units. Maybe the seller was willing to carry $100,000 deductible. You just don't know what the seller's situation was. So when you use the seller's numbers, you can get in trouble. The property, what's that? Wasn't distressed to then? Oh, the property wasn't distressed then. I couldn't read my own thought there. Yeah, right. It wasn't distressed when they put it in place, right? So there we go. And say the seller owns, 4,000 units. So what happened? Well, she had to leave this deal in the middle of due diligence because insurance was 70K instead of 30K. Now, was that the only reason? I don't know. I didn't have, insight into her entire scenario, but certainly a $40,000 difference in your underwriting on something's going to change your NOI and address some of the make a problem for you potentially. So I don't know how much she lost, but I know she lost a $2 million deal in that situation. What is the lesson? If you aren't sure, especially a lot of you, when you introduced yourself, said that you're early investors, connect with an insurance advisor and ask them if you have a call with them, connect with them, say, hey, I'm early in this. I'm wondering if I can shoot you some addresses and you can shoot me some ballparks about these properties. A good advisor should be able to shoot you ballparks or say, because of these given factors, it's going to take me a lot longer to figure it out. If Janine had asked me early, I wouldn't have just texted her a ballpark right off because I would have known the situation. This is a heavy lift. There's a lot going on here. I can't just ballpark that because I'm not sure what these insurance companies are going to come in at. I need some time to figure that number out. So you should be able to have an advisor who can do that for you. Either share a ballpark with you if they know the market and they know the property and things look pretty good. Great, get some numbers, right? So ask for ballparks. If an insurance advisor isn't willing to spend a little bit of time, helping you build your knowledge about how to underwrite multifamily properties, maybe they're not the right person, And so don't be afraid to ask for help. I think that's probably advice Jerome gives all the time and Lawrence gives all the time. Ask people for help. We're a community. We rise by lifting others. We all get that. And we should be able to help you if you're early in your journey, even if, we don't close a bunch of deals or whatever. I have lots of investors that I help who have not yet closed a deal. And I know that when they do, they're going to come to me because they're already coming to me when they're not closing deals. And that's fine. Never trust the seller's numbers. It's just that simple. I already explained why. So any questions about Janine?
So when you have to do a heavy lift, why is there, how do they determine the difference of insurance as opposed to something that is just a minor, like put lipstick on a pig sort of buy?
So I break insurance companies into 3 tiers: tier 1, tier 2, and tier 3. Tier 1 companies are going to have the best price for the most coverage. Tier 2 companies are going to have a little bit worse coverage and a little bit higher price. Tier 3 companies are going to have a lot higher price and significantly worse coverage a lot. Depending on the state of the property, I might be able to get tier 1 companies, but tier 1 companies are picky. They say no a lot.
Okay.
And so if you have less than 80% occupancy, or you're on the coast, or you're student housing or assisted living or heavily subsidized, or it's built in the 60s, or, I could go on, it has aluminum wiring. So tier 1 companies have a really tight guideline for what they'll say yes to. They got the best prices, but they're going to say no a lot. And tier 2 companies are going to say yes a little bit more. And tier 3 companies are basically companies built for stuff that everyone else said no to. So when someone asked me for a quote this morning in Miami, Florida, on a 70 unit complex, I knew I was headed straight to tier 3 companies because there really aren't any tier 1 companies in Florida. They're just not in Florida. So I think that's the biggest reason you see pricing difference. So this example of Janine, tier 1 companies aren't going to say yes to a property that has less than 70% occupancy and a heavy renovation is about to happen. Okay. So you got to go to those tier 3 companies. You're going to see an increase in price, potentially even double the price in that scenario. Does that answer your question?
Are the bigger name folks, bigger company names, are they synonymous to a certain tier?
It depends. I think that Nationwide, Liberty Mutual, Travelers, State Auto, these are the top ones that come to my mind that are those big names that you would think of. I would consider all of those tier one companies. You hear Berkshire Hathaway and Lloyd's thrown around a lot. Those two aren't one company. Berkshire Hathaway has, I don't know, 20 insurance companies. So I work with two different Berkshire Hathaway companies, one that's for high risk stuff and one that's a tier one company. So it kind of depends. Lloyd's is generally a tier three product for the most part. They're not generally a tier one company. They sometimes can get tier one pricing, but it usually isn't tier one coverage. Did that answer your question?
Yeah.
Okay. Any others? All right, two more. Donnie, residential schedule, Burr, Indianapolis, Indiana. His mistake was get her done. Just add this one like all the others. So what happened with Donnie was Donnie picked up a property, called his insurance agent and said, hey, I just picked up a property. Here's the property address. Can you add it just like all the other ones? Insurance agent said, sure, added it, no other conversation. This was a flip. So picked up a single family home. No one was in it, totally vacant, planned on renovating, putting about 50K into it. Started that process. One of the contractors come out and they're drilling into the siding, I think to put in like electrical of some kind or something. They create a smolder inside of the wall, leave to go to lunch. Smolder turns to a spark. I don't exactly know how fires work, but like fire starts, burns down building gone. Calls insurance agent and says, hey, building's gone. Insurance agent says, no problem, we'll file the claim. Insurance company ultimately denies the claim. And I think this is one of the reasons people hate insurance, because you hear this and you're like, what? And the reason was the insurance agent added it just like all the others. All the others are tenant occupied rentals that have renters in them. This was a vacant property that had no one in it. Insurance company denies the claim. Now, Donnie was okay. Donnie was fine. He had 30 properties. I mean, he lost a lot of money and it sucked. I'm not playing down the fact that it sucked, but it didn't crash him, but for someone who's earlier in the process, could it crash you? Absolutely. So, the problem here is didn't give the agent enough info, right? And the outcome is fire happens and claim denied. Now, I think there are a lot of insurance companies. I don't want to say this too strongly, but I think that insurance company, I think some insurance companies would bend on that. But our goal here is not to create things that bend in bad situations. We want to do it right from the first place, so we're not in the situation, right? But fire happened, claim denied, no coverage. The claim denied because of an incorrect occupancy. So what's the lesson? Well, one, for this particular example, is always share the correct occupancy. But I think this is the one that I struggle with the most, because it's take time to inform your agent thoughtfully. No one wants to waste your time. I hate asking 1,000 questions of someone I know and respect and owns 2,000 units across the country. The last thing I want to do is waste their time. The thing I want to do the most is make insurance simple. But I know that I have to ask the right questions or I don't get it right. And if you have an insurance advisor who's not asking you any questions, that's kind of a red flag. Like, yeah, you don't want to answer a bunch of questions. Nobody wants to answer a bunch of questions. But is there enough information so that they can set it up correctly? Because if you're paying $10,000 for something that's not going to, cover you when you need it, then what's the point of buying it in the first place? So take the time to inform your agent thoughtfully. That was the end of that one.
Is that
Yeah,
a
go ahead.
question that an agent should ask you?
Yeah.
Right.
I'm sorry, I missed the beginning of it. Say that again.
Isn't that a standard question that an agent should ask you also?
100%. Should be one of the first questions.
Okay.
Is, what's okay, you're picking up a new property. Are you, I think my question is usually, what's the plan? And my clients are like, they know the drill. And so we go through that and then we get it right and we make sure it's right. And there's insurance companies out there who can have a schedule of 30 properties. And if it's vacant, you just add it as a vacant property. If it's an annual tenant, then you add it as a tenant occupied property. If it's an Airbnb, you just add it like that. And the schedule is flexible enough to be able to handle that. There are a lot of insurance companies that can't do that. And so you just have to, navigate that in however your insurance advisor is capable of doing it. Did that answer your question?
Yep.
Okay. Anybody else?
Hey, Jeremy, I have a question.
Yeah.
So do you have any clients that reach out to you every time they analyze a deal, or are there like rule of thumbs that you would say are pretty accurate when you're just basically analyzing? You're not even sure if you want the deal yet.
I think most of the people I work with are respectful of my time. So they're trying to, as quickly as possible, get numbers and hear some consistency in a market and then use those numbers, right? So they may, before they, like right when they're analyzing a deal, say, hey, here's the market, here's the property, here's here's the address. What do you think? A couple of times. And then generally they won't bother me if it's a similar thing, because it's going to be in a similar space. But they also know if there's something weird about it, or weird is the wrong word, but something that, creates insurance issues, and they will check in with me. So yeah, I have people, I have one person who Facebook messages me addresses, maybe more than really is respectful, but I always answer. And they're getting the numbers that they need. So what I don't want someone to do is make a mistake on it just because they don't want to bug somebody. At the same time, I have a lot of clients. I'm obviously a busy person, just like we all are. So respect is important, as it is with everyone. Did that answer your question?
Yes, it did. Thank you.
Yeah. I think generally when most people ask is early due diligence. If you have an accepted LOI, now it's time to engage your insurance agent. Just make sure we're all on the same page, things are good. And then generally, deeper into due diligence, we're going to make sure we have hard quotes. We're ready to go. We know if the lender is an agency lender, because if you're borrowing from Fannie or Freddie, that's a whole different ballgame than if you're getting a bridge loan, or you're you're syndicating without any lender or something like that. So we're going to start to really dig in to the actual numbers and make sure that ballpark hits, or if it doesn't hit, that we're clear on exactly where we're at before a week before closing.
Right. Okay. Yeah, and I know it would be a lot more. I guess it would be an easier process if you already have a feel for the market and what insurance typically is. But for newer guys, we might not know, where insurance should be. Are there any rule of thumbs that you use, or is that also based on a market? Like, is there a average?
Yeah, it'll be somewhere between $200 and $1,000 a door. No, I'm just kidding. I'll be more specific. I'll be a little more specific than that. There's some rules of thumb. I think that some coaches will say put $350 a door in. I think there's a coach out there saying put $250 a door in. Don't do that. If you're just going to make up a number, put 400. I think that's probably the most average number that I see. It's 400 a door. But the Midwest, it's the Midwest, standard stabilized multifamily property with square footage that's normal, somewhere between $700 and $1,000 a door. You're probably looking at somewhere between, $300 and $400 a door. Florida, you're not going to get under $700 a door. Texas, it depends on what part, but probably $500 to $600 a door. Don't hold me to any of those numbers, but
okay.
I think the most important thing is that you have some sense of a market. If you have no sense of a market, send me an address. And if you know the seller's insurance number, let me know that. Hey, Jeremy, can you help me with this one? Here's the address. Seller says premium is $4,500. What do you think? I'm happy to help you with that.
Okay. And you also work with companies in Illinois?
Correct. I do.
Okay.
Yeah.
Great.
Somewhere between, yeah. Yeah, even in Illinois. Even if I have one in Illinois that's under 300 a door. I thought that was solid. I think it's 275 at 100 unit complex. I have another one in Illinois that's over 500. It was built in 1945. There's a lot going on, and those are both stabilized properties, let alone when you start to get into, heavy lifts or something like that.
Okay. All
Okay.
right.
You want me to do the last one? You ready, Lawrence?
Let's go.
All right. Josie and Maria. These two are great. 36 unit value add property. Wow, it says Cincinnati and Indianapolis. That's pretty amazing to have a property in two completely different markets. Now, this was in Cincinnati. It was not in Indianapolis. And this is one that I think I hear a lot, and hopefully none of you will have this, because I hope even in this conversation, it's really helped. I don't understand, but hey, that's insurance. It's hard to understand. I don't get it. No one else does either. So that's just the way it is. What's the problem with that? Well, the problem with that is so many insurance agents never make any sense. I think if you call someone, spend 15 minutes with them talking about insurance, and you feel dumber than you did before you got on the phone, you're talking to the wrong person. It's not you, it's them. You know, is insurance complicated? Yeah, there are complicated elements of it, but it should be able to be explained in a pretty simple way. And I think especially when people are always explaining in generalities. Now, it is important to say, it is impossible for me to tell you if X claim will be covered. You know, I can give you examples of how I think it will be covered, but ultimately when a claim happens, the insurance company looks at all the variables of what happened there. And so sometimes generalities have to happen, but I don't think they need to always happen, if that makes sense. Maybe that was too general of a way to talk about generalities, but anyway. And just send you documents that don't make sense. So there's no communication that works. So the outcome, well, in Josie and Maria's scenario, when they came to me, the problem that they had was just simply that they didn't have peace of mind. They just felt like, I don't have any protection for this asset. And so they didn't have any peace of mind for it. And so, what can we learn? Well, in my opinion, connect with a CRE specialist, someone who understands this world. There's plenty of good agents out there who do. And I think it makes sense to work with people who understand this space, understand the type of properties you're picking up and the idiosyncrasies of that. Ask questions and note whether they're able to communicate insurance in a way that makes sense. I mean, this is what we do for a living. We should be able to communicate it. If you got on a call, if you wanted to be an LP investor and you got on the call with the syndicator and you walked away feeling like, I have no idea what that deal really is, would you wire $50,000 or $100,000 to them? Absolutely not. You'd move on to the next one until someone could explain a deal that connected with you and your investment goals and the types of things that you want to get involved in, right? Treat your insurance advisor the same way, and every other service provider for that matter. Make sure that people can explain things in a way that makes sense. So what were the crimes? Cheap. Go for the cheapest one. Ask a bunch of insurance agents to work together on it. Sellers, the feller, using the seller's numbers for what you underwrite with. Get her done. Hey, just add it to my schedule without answering any questions or making sure that some basic information is correct. And I don't speak insurance. Hey, it must just be confusing for everyone. I guess I'll just have to go from there. Kenneth, I think I saw that you raised your hand. What's up?
Hey, Jeremy, thanks. That's a great presentation. I have a question for you. You sort of mentioned, sort of goes along the lines of, like, say we're doing not really heavy value add, but we're doing some value add work on a property. Maybe we're going from bridge to agency did or more expensive. How often should we talk to our insurance advisor or agent about getting a property we already have, like either requoted or an updated quote? Is this when the policy expires, or like a major action on a refinance, or should we ask every year, hey, can you requote this? Or, how would that process go? Even if we had not done a lot of work to it, would you still ask for a requote every year, or,
It's a great question. So definitely those key moments, right? If nothing else, at annual renewals, you should be having a conversation. What I do is at the annual renewal, I set up our portfolio overview, which is a document we use with all of our clients. It's just real simple, easy to understand. And then I create about a 10-minute video. Sometimes it's 7 minutes, sometimes it's 8, but, and I just say, here's what I see. Here's what I've done. If it went up by 10%, then I remarketed it already before I even reach out to you. I had one, I have a renewal going on right now where she had a liability claim this past year. Someone slipped and fell. and broke their arm. The person hired a personal injury attorney. Could turn out to be, and it looks like it's going to be somewhere between a $40,000 and $60,000 claim. So we're remarketing that one together. So that maybe is an unusual, well, that's an example of when you definitely would remarket it. But I think that key moments, I think you got it right. Key moments. And if you see annual increases, you want to at least understand why. In Florida, unfortunately, right now, 15-20% increases are happening across the board. There's not a ton that can be done. Other places, there is something that can be done. For that person who has the claim and had a 30% increase on her annual premium because of the claim, I'm not only pitching to the company who it went up by 30%. This is ridiculous. Here are the safety systems she has in place so this doesn't happen again. I want you to come back to me with a better number. But I'm also marketing it out to everybody else. So I think having a partner is key. And I don't market everything every year. If I had a renewal for a portfolio of about 500 units this last couple weeks, it went up by 3%. The annual premium went up by 3%. Well, the property coverage itself went up by about 3%. It's a pretty flat renewal. I'm not going to penalize the insurance company for being flat, but for being stable by remarketing out to everybody for that year. But if they go up by 10% or something like that, then I am. So asking your insurance advisor how they play it. And if you say, hey, I want you to remarket it every year, I might say to you, that's just not how I work. I'm not going to penalize my companies like that. But you certainly could find an insurance advisor that would say, yeah, happy to do that. Does that make sense? Did that answer your question? All right.
And then
Cool.
if there's any like major changes, like I think I mentioned like the refinancing, like, and say it's like wasn't distressed, but it was a heavy value add. Now you got it up to like to maybe to 90%. Are there any like benchmarks that might help us get better rates, like 90% occupancy? Like, agency debt is always 90 for 90 or something like that. Are there any like key things, like if it's below 50, you get the tier 3 lender or tier 3 insurers, but once it gets up to about 8 or 90, that's when the tier 1 guys are interested. Is there any like key things that we should watch out for that hey, maybe next time, or maybe not get a requote right away, but on my renewal, I might be able to get a better insurance company or a better rate?
1,000%. If you're in one of those tier 2, tier 3 companies, and your insurance advisor should be like, all right, we're going to do this for this year because of this factor. And as soon as that factor is gone, let's remarket it and get it out. Let's see if we can get it into a tier 1 company. Now, there's some variables. If you're, sometimes insurance companies have penalties for canceling 3 months into a policy term. So it may not make sense to cancel 3 months in because you don't get all your money back or something like that. There's all sorts of variables. Your insurance advisor should be able to walk you through that. But yes, 100%. If you're in an insurance tier because of a factor and that factor is gone, it is time to get to the next tier, as soon as possible. So I think I've talked enough. We're getting close to the end here, but just as far as the solutions, I think I've articulated them pretty well at this point. But pick one advisor. If you're early and you want to if you want to have 2, then pick the one you like to give it to first, and then say, look, I'm here to establish relationships, but I want to take a look at a couple of advisors through the process. I'm talking to you first. I'm going to talk with someone else, and I think that makes sense. The other thing I would do is decide which one you trust the most and give them both quotes and let that person analyze it. You're not the insurance expert. Let the insurance expert analyze the difference. And if you trust them, then they should give you an honest assessment of the 2 insurance policies and the pros and cons of both. I think when I see people just take my quotes and then try and be the insurance expert, it's just really frustrating because I know it's not that I can do it better and I would do it happily for them. So who is a CRE specialist who asks the right questions and offers clear advice. If you'd like us to help, we're more than happy to help. We have a Shine Shield program where we protect your money, we protect your properties, and we protect your community. We help you build a program where you're doing that. And when your investors ask, how do you manage risk? you can answer simply the Shine Shield and put it into your slides when you're presenting to investors and all sorts of other things. So more than happy to help. I'm going to stop sharing my screen, Lawrence, if that's okay.
That's good.
Cool. There we go.
Thank you, Jeremy. Thank you very much. That was an awesome presentation. This is stuff I never thought about this before. Never thought about some of the things you're saying, because I'm going to admit I like to bandy around. What do you like to bandy around everybody to see I get a cheap quote, right? And there are times when a lot of times cheap is not the best.
Yeah.
Especially because when you said about the four issues, but you said something that before we first got on. What is one of the biggest problems you see with investors in insurance?
It's mindset. It's thinking that insurance is a commodity. And I hope that in this conversation, I've proven to you, even just in the insight from this 45 minutes, that having an advisor matters. Having someone who articulates things matters. If you are going to go out to 4 different people, at least do that last thing I said before I ended. Give the quotes to one person, the person you trust, and say, would you be willing to break these down and tell me the differences and similarities? I'd love to work with you, but your price is 10% above everyone else's. That takes away from my NOI. I can't wrap my mind around it. Will you articulate to me the difference in what you're offering and what everyone else is offering? Give them the chance to be the expert, to be the advisor. The best part is that's free. We don't make any money until we put a policy in place.
Okay.
So ask someone who you trust to be that advisor. If someone's schlepping you quotes, they're not an advisor, they're just an agent. And I think there's a big difference between the two.
Well, you've proven today there's a difference between agent and advisor. You're definitely an advisor. Definitely an advisor.
Thanks.
Anyone else has some questions? You look at Anthony, you look, you have Roel, look, you have some.
Go ahead. Sorry about that. I was trying to get it to unmute.
Okay.
I don't have any questions. I just appreciate you guys letting me be a part of it tonight.
Thank you, Anthony. You're welcome. Roel, look, you have Roel, you're twisting your knuckles white, man. What's going on? You have a serious, you're rubbing your forehead now. Everything okay over there? What's the question? You're muted.
Yeah, I had a question. So some folks that I know skip the whole LLC establishment altogether. For an exchange to that is putting an umbrella policy or a wider umbrella policy on their properties and thinking that they would be covered. And some people say, well, some of those folks don't pay out because of any liability that may happen. So any thoughts on that? Creating an LLC, which actually protects you. But then again, there's some people that bypass that and just say, oh, you know what, I'm just going to put an umbrella policy on top of that.
Absolutely. So I think at the end, I said, those 3-pronged approach, that's protect your assets, protect your money, protect your properties, and protect your community. I think that this question really hits on the protect your money piece. There's 2 key ways to do that. One is a legal arrangement that separates you personally from your investment properties, an LLC or an S Corp or a C Corp or whatever you choose to do based on your insights. The other is insurance. I think that both have value. I think that you should have enough insurance, especially liability insurance, to cover at least the value of the assets in your LLC. I personally would not invest definitely in multifamily. If you have 1 or 2 single family homes and you buy them in your personal name, I don't necessarily see a problem with that. Make sure you have enough liability coverage, like you said, so that your insurance policy would address that risk that you're taking. Other people would disagree with me and say, no, create an LLC, the first single family property you buy. I do think that's safer. So, it's really up to you though. But when you get into multifamily, I think you have to create that separation. So important to create that legal separation from you and your properties, because let's say you got an 8-unit property, the risk is 8 times bigger than a single family home that someone slips and falls and hires a personal injury attorney. And so now the amount of risk that you're taking on with 8 units, let alone 70, is enough that you need to do multiple things to protect yourself. One, you need to create an LLC. 2, you need to make sure that you have enough liability coverage over the top of that LLC, over the top of that property. And then I suppose the other piece would be that you make sure you have non-recourse loans so that if things go south because of something over there, that they can't cross over that veil and come and get your personal assets. So I don't think there's one answer. I think having a really big umbrella and just saying that protects me is not a smart idea. I think you should have an LLC because it creates a very clear separation between you personally and your assets. But liability insurance is one piece of that entire plan on how to protect your money.
Thank you.
Caroline, how you doing? Look, you have a question. I see you shake your head. Look at you mumbling to yourself.
No, I don't have a question. I want to just, thank you for having me and doing this. I actually spoke to Jeremy last week and talked to him about getting some quotes on some properties. So yes, he's really good. And I can vouch that he's definitely an advisor and is not just slipping quotes to people. So just here to support.
Thank you, Caroline, for being Caroline. That's a ringer.
I brought a ringer. Thank you, Caroline, for being the ringer.
Thank you, Caroline. Hey, hi, good to see you, Caroline. Good to see you. Good to see you. Just to let you know, that's another fellow New Yorker. Hello, New York.
Mm-hmm.
Right?
She's a school teacher in New York.
Yes, indeed. Yes. 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 Jerry, you got something to say to you? Unmute yourself, Jerry. Okay, Jerry. I thought Jerry's muted. Jerry, you got okay. Okay. So, Jeremy, I don't know. Anybody have any more questions before we go? We're gonna go to breakout rooms. Okay.
Can I sneak in one more? I'm sorry, man.
Listen. Well, you got to sneak in because you don't have to sneak in because this is about information. Information is pure knowledge here.
Yeah.
Like,
so
like
I mentioned earlier. Yeah, I mentioned earlier that I'm diving into boarding homes. Actually,
right. Yeah. Yep.
Put in an offer for two of them that's going to close hopefully next week. So any type of like advice on extra insurance or just general insurance on those types of properties?
I insure a few, and it's a little bit different beast. The only real difference is just a little bit harder. It's sort of like with assisted living or heavily subsidized or student, where there's just an element of it that a lot of insurance companies shy away from. And so you're less likely to get a tier 1 insurance company, and you're more likely to get a tier 2 or a tier 3. So I think the biggest advice I would have is not really about some special coverage. It's more about making sure you have an answer to what those numbers look like when, I don't know what point in the process you're in right now, but you need to be clear about the cost of insurance on boarding homes because it may be a little bit higher.
Okay. Cool.
You got another question, Roel? Because I didn't have to sneak this time. Listen, I want to say thank you, Jeremy, for enlightening me. I'm sure enlightening everybody else here tonight. Truly, you're an advisor, not an agent, and it's very good to open your eyes. You did say you promised me that you're gonna look at insurance a different way, and this is really gonna make me look a different way for insurance. So thank you for coming. Appreciate your time, and guest to the family, guest to the show. Part of the family here.
I love it. I really appreciate you having me, Lawrence. Thank you so much.
Thank you. Thank you. So now we're gonna go to breakout rooms. We'll stop the recording. All right, here you go.